Now we're rapidly closing in on September. The US Federal Reserve continues to signal the beginning of the end of its money printing program will soon be upon us, and international markets are jittery. $85 billion a month are being pumped into the system, and fears of a winding back have seen billions in funds pulled out of emerging market economies. Asian markets and currencies were thrown a lifeline with figures today from China's manufacturing sector, but that's only partially stemmed the flood of money out, threatening a credit crunch or worse. Here's Phil Carey.
Across emerging markets, currencies are under pressure, market confidence fragile, and the cheap cash is already pulling out. The US Federal Reserve's massive money printing program, known as QE, has been disgorging cheap money beyond its borders for the past few years. But talk of a US recovery has it ready to move back to the developed world, and stopping it won't be easy.
Of course, the central banks in the emerging economies aren't quite as experienced as, for example, the US Federal Reserve or the European Central Bank or indeed the Bank of Japan.
In the past 7 months, $156 billion of investment fund money has been poured into advanced economies, and $8 billion has been pulled out of emerging markets.
If they do make a mistake, then things can turn sour pretty quickly in markets, and so that's really where people can lose confidence. And of course, once confidence is gone, it's very hard to get it back before financial markets plunge.
Well, we're seeing something of a slowdown or a panic in emerging markets as the flow of cheap credit there seems to be drying up to some extent. The problem, as with most easy credit, is that we've seen some unsound projects falling over, and that's creating, in particular markets, a sense that things could go bad.
Just how, where and why things could go wrong varies from country to country. Thailand, in technical recession, and in 4 years household debt's gone from 55 to 80% of GDP. Malaysia's share market down heavily, a housing boom with an economy slipping towards deficit. Indonesia is in deficit, has falling commodity prices and surging inflation. China's monetary policy has kept pace with the US, creating an oversupply of credit, also creating an overinvested property market, overcapacity in heavy industry and export prices that are falling. And then there's India.
The path from financial system stress to financial crises, and something that the world's got to worry about, probably the key country here, I would believe, is India.
The 9th largest economy in the world, India's debt to GDP ratio is 66%. It has a very large budget deficit, a large current account deficit, and its currency is at record lows. And on top of all that, India's growth rate has dropped from 8% last decade to less than 5% now. And to make matters even worse, its sovereign debt is on the brink of being tagged as junk status.
The central bank and the government have been trying to stabilise the currency. They've been trying to stabilise the government funding markets, but it's just not working. It's kind of like trying to forecast, when a volcano is going to erupt.
We've certainly seen a couple of what certainly could be canaries in the coal mine in the shape of Indonesia and India in the last month to 2 months. It's a huge problem. I mean, we've never seen anything like this in recorded economic history, certainly not to this scale. We have a global problem here. A lot of people are shrugging this off as the normal sort of gyrations of emerging markets, but I think potentially it's far more serious than that.
And as a result, investors will be watching closely over coming months to see if the fund's outflow grows from a torrent to a flood and washes through global currency markets.